All right, we are live. Hello, everyone. I'm Ron Russell, Program Director here at Humanist Society of Greater Phoenix, and welcome to HSGSP's special event with Patriotic Millionaires, Taxing the Rich, Save America. Could it really be that simple? Some basic ground rules. Please stay muted unless you're actively speaking, and don't be offended if I mute you due to background noise. Raise your hand, ask questions during the Q&A, and I will call on you. Type questions will be read aloud. Please don't forget to hit the like button on YouTube and subscribe to get more of our awesome content. Today, we have Morris Pearl, Chair of Patriotic Millionaires and former Managing Director at BlackRock, and Frank Patucci, Chairman, CFO, and majority owner of New Compass Mobility, with our presentation today, which is Tax the Rich, Save America. Could it really be that simple? With that, I would like to pass it over to Morris and Frank. Take it away, sirs.
Hey, thank you so much, everybody. Thank you, Ron. Thank you to the whole Humanist Society. We hope you guys enjoy our show. If you've not read our book, send us your address and we can send you a book if you want. But let's start. So inequality is the root cause of social unrest. It's higher now than it's been in 100 years, and it's getting worse. 70% of Americans think the economy is rigged against them, and they're right. So Frank, how do you rig an economy?
Well, it's easy, Morris. You start with the tax code. During World War II, the top marginal tax rate was 94%. During the Eisenhower years, it was 91%. Today, it is about a third of that, 37%. So who's in charge in Washington has changed countless times over the last 70 years, but the tax rate for the richest people in the country has only gone in one direction, and that's down. Most legislation gets bipartisan support, so it's been hard to know who to blame. But that changed in 2016 when the Republican Party took over the entire federal government. They had so much power, they didn't have to act in a bipartisan way. In 2017, they used that power to rewrite the entire federal tax code.
Now, to be clear, some of this nonsense in the tax code has been around for years. But in 2017, Republicans had to take full responsibility for it. They're the only ones who voted for it. They have to own it.
In 2018, the year after the Republicans rewrote the entire federal tax code, for the first time in history, billionaires paid a lower effective tax rate than any other income group in the country. Let's see how that happens by comparing a regular person's taxes to a rich person's taxes. Let's begin.
So say that two people, we'll call them Joe and Cammie work hard, both worked full time last year, putting in 40 hours every week. Together, they made $100,000, just above average for a two-earner household. They're married, and they'll file their taxes jointly. So after taking the standard deduction and paying into Social Security and Medicare, they end up with $75,200 in taxable income.
Okay, let's step back and explain a couple things. Here's a chart of the federal tax brackets showing how much you pay at each level of income. Everybody gets a standard deduction. You only pay taxes if you make income above that level. We have a progressive federal tax system, meaning you pay a slightly higher percentage of your income in taxes the more you earn. So after the standard deduction, a married couple filing jointly will pay 10% on the first chunk of their taxable income, 12% on the amount after that, and so on, until they reach the maximum rate of 37% for income over $622,000. Everyone pays the same rate as they move through the tax brackets, and everyone maxes out at 37%, whether they make $622,000 or $622 million. 37% is the max.
So back to the work hards. It's $75,200 of taxable income. After the standard deduction, the work hards will pay 10% of the first chunk and 12% of the rest, for a total federal tax bill around $8,600.
Now, say there's two other people, we'll call them Ronald and Melanie Slump. They sit around all year tanning on the beach. One day, Ronald clicks a button on the couple's E-Trade account sells some stock, and makes a profit of $100,000. The slumps, to report that income, would take the standard deduction and be left with $75,200 of taxable income, just like the workhards. They made the same amount of money, so the slumps should pay around the same amount of taxes as the workhards, right?
Wrong. Under our current tax system, the slumps will pay zero in taxes on that income. The workhards worked hard all year trying to get ahead, while the slumps, who are already rich, sat on the beach drinking strawberry daiquiris. At the end of the year, the workhards are almost $9,000 poorer than the slumps. So how does that happen?
I'll tell you how. Republican lawmakers who wrote the new federal tax code believe that money should be taxed differently depending on how you make it. Here's a comparison of the rates side by side. Like the workhards, most people make ordinary income. You work, you make money from that income, you get a paycheck, and taxes are withheld from that paycheck. Other people, and this is mostly millionaires, make capital gains income. You buy an asset like a stock, it goes up, you sell it for a profit, the profit is considered capital gain. Capital gains income is taxed at a much lower rate than ordinary income. So if you work for a living, you actually pay a higher tax rate on your income than people who live off of investments. But that's not the best deal in the Republican Party tax code. The best deal is to inherit money, like Donald Trump did.
Let's say the workhards got new jobs, singing full-time for America Sings. They're such good singers. Last year, America Sings paid them $11 million. They paid Social Security and Medicare, took the standard deduction, ended up with just under $11 million of taxable income. They pay 10% of the first chunk, 12% of the next chunk, and so on, maxing out at 37% for all that income above around $622,000. Workhards' total tax bill for the year, around $4 million. Making $11 million a year is hardly reason to sing Cry Me a River. But how does the workhards tax bill compare with the slumps tax bill?
Well, the slumps didn't pay $4 million. The slumps had a very good year. Mr. Slump's great aunt died, left her $11 million estate to the slumps, and they weren't even very close in the family. So how much did the slumps pay in taxes on their $11 million of inheritance income?
Nothing, zero, nada. When Republican lawmakers rewrote the federal tax code, they exempted the first $11 million of every estate, over $22 million for a couple. Once again, the workhards and the slump took in exactly the same amount of pre-tax income. Because they earned their money in different ways, one couple by working, the other couple by waiting for someone to die, the slumps ended the year $4 million richer than the workhards.
So we've talked about income. Now let's talk about wealth. Wealth is the total value of all of the assets a person owns.
And half of Americans have no wealth at all. But for the ones who do, they may have some money in a retirement account or in the stock market account, but the majority of their wealth is their primary residence, their homes. That is not true for rich people.
Well, rich people may own several houses. Most of them keep their wealth in all kinds of other investments, things like stocks, art, jewelry, yachts, and 14-foot long preserved sharks. Yes, this is true. A billionaire paid $8 million for this preserved shark. So how are different kinds of wealth treated by our tax code?
Back to the workhards and the slumps. The workhards' wealth is basically their home, a lovely little house in Dayton, Ohio, with an assessed value of $250,000. Homeowners pay around 1.68% in property tax in Dayton. So for the workhards, the tax on their wealth, their home, is around $4,000 per year. They'll pay that in property tax every single year. The slumps also keep part of their wealth in a lovely little house in Dayton, Ohio, with an assessed value of $250,000. They use it to store their furs in the summer. Like the workhards, they too will pay property taxes on that part of their wealth for a total of $4,000 per year.
Now, the slumps used to own more houses, but Mrs. Slump really doesn't like paying taxes. So several years ago, they sold all of their houses except the one in Dayton. Mrs. Slump was worried that her furs would be traumatized if she had to move them. They made $500 million on the sale of all of those houses. With the $500 million, the slumps bought a small yacht, a large plane, 3 Picasso paintings, one from the Picasso Blue period, a pink diamond, 2 prize racehorses, and a decorative flower pot filled with antique gold coins. Morris, what was the total tax bill on this part of their wealth?
Zero, nada, nothing. The workhards have wealth of $250,000. The slumps have wealth of $500,250,000. But the annual tax on their respective wealths is exactly the same.
You may have thought that we broke away from England in part because of taxes and started our own country because we wanted things here to be different. But take a deep dive into our tax code and you'll hear God Save the Queen playing in the background.
That's right, Frank. The Republican lawmakers who wrote the new federal tax code clearly prefer a permanent aristocracy. You want proof? Remember how capital gains tax works? You buy stock for 1 million, you sell it for 10 million. You only pay tax on that 9 million you gained, and you only pay those taxes if and when you sell the stock. Simple enough. But what if you bought that stock for 1 million, it grew to be worth 10 million, you never sold it, and then you died? At your death, the stock goes to your heirs. In the new Republican tax code, when your heirs inherit that stock, poof, the cost basis magically changes. Instead of the basis being 1 million, what you paid for the stock when you first bought it, the cost basis stepped up to 10 million, the value it had on the day that you died. When your heirs sell that stock, they will only pay tax on the gains above the new $10 million value. 9 million of capital gains totally wiped away for tax purposes.
Well, that's one gimmick. Here's another one. It's called the 1031 exchange. It allows investors to avoid capital gains taxes when they sell a piece of property if they immediately invest the money in another similar property. Let's say a developer buys a building worth $10 million, holds it for a few years, then sells it for $60 million and buys 1,000 buildings with that $60 million. He is $50 million richer, but still has paid no taxes. If he dies, his estate will pay some estate taxes, but his heirs will inherit all of that $60 million property on a new basis. That's how millionaire real estate families acquire billions of dollars of property without ever paying taxes.
Let's think about that for a minute. On one side is the wealthy heir who never worked, who inherited millions of dollars and contributed nothing to the country. On the other side are people like the workhards who go to work, pay their taxes, and do their part for the country every day. And between 1/3 and 1/2 of wealth in America is inherited. There's nothing wrong with inheriting money, of course, but there's no reason at all that inheritance income should be taxed differently than other kinds of income.
Well, let's turn to corporations, one of my favorite topics. In 2020, if you bought a single pair of Nike socks, you paid more for those socks than Nike paid in federal taxes for the entire year of 2020.
If you sent a single package through FedEx last year, you paid more for your delivery than FedEx paid in federal taxes for all of 2020.
Morris, how the heck does that happen?
Well, Frank, there are a lot of ways. One of the main ones is the new federal tax code allows companies to pretend they do business somewhere other than where they actually do business. Let's take a company like Starbucks, for example. Say Starbucks has several thousand stores in the United States and a few dozen stores in Ireland. You'd expect them to pay a lot of tax in the United States and much less tax in Ireland. That would make sense. That is not the way it actually works. Most large companies have what's called intellectual property, a trademark or a patent, for example. Unlike land and buildings, intellectual property can transfer to another country as fast as you can click send on an email. Picture that Starbucks logo. A smart lawyer can transfer ownership of the logo to Starbucks of Ireland, who would then legally own the logo. In order to use the logo, Starbucks of the US would have to send royalty payments to Starbucks of Ireland. The company can make the royalty payments whatever they want. If they make the payments big enough, the company will show all of its profits in Ireland, where tax rates are much lower. even though they sold hugely more coffee in the United States. Using this and other tricks, 55 of the largest US companies paid 0 federal taxes in 2020. 0. So here we are again. The work hard's holding up their end of the bargain and everyone else shirking their responsibility.
Now, rich people and CEOs love pretending that there are good reasons why they should pay lower taxes than everyone else. Their favorite reason is that their businesses are job creators. Woohoo! Like they're magicians. They create jobs out of thin air just by waving a wand.
In 2017, a lot of these CEOs insisted they would hire more people if Republicans cut the corporate tax rate. They even launched a big job creators bus tour that went all over the country. The CEO of AT&T, Randall Stephenson, is one of the biggest cheerleaders for the corporate tax cut. He insisted the correlation between tax cuts and job creation was very, very tight. But keep in mind, corporations only pay taxes on their profits. Profits are calculated after deducting expenses like payroll. So Mr. Stephenson's claim doesn't even make sense on its face. But be that as it may, maybe he was just confused. Maybe he thought he would hire more people if the corporate tax rate was lower.
I don't think so. You see, from 2008 to 2015, AT&T paid an effective corporate tax rate of 8%, well below the standard corporate tax rate at the time of 35%, which my company paid. During that period, the AT&T cut 80,000 jobs. Now, since the new Republican tax code went into effect, AT&T has cut another 40,000 jobs. In the last year that Mr. Stephenson was the CEO of AT&T, he was paid an income of $32 million.
Now, investors like me also pay half the tax rate of people who actually work for a living. Lawmakers justify that lower tax rate by saying investors are job creators and insisting if we raise their taxes, they won't invest. That just is not true. But let me explain. Apple, for example, employs thousands of people to make iPhones and computers. I am an investor in Apple. I have hundreds of thousands of dollars worth of Apple stock. But none of the money that I spent buying Apple stock even went to the company, Apple. It went to other investors who happened to be selling their stock that day. People who work at Apple have jobs because of the millions of consumers who want to buy iPhones, not because of investors like me. Consumer demand is the only real job creator. And to be clear, investors are not going anywhere regardless of the tax rate. The alternative to investing is to stick your money under your mattress. Last I checked, mattresses do not provide very high returns.
Regular working people pay twice the tax rate that Morris pays. So even if you had the same income that he does, you end up every year worse off and behind the curve. But there is good news. We can fix all this with your help. If you want to know more or join the fight to unrig the economy, tax the rich, and save America, then please visit our website, taxtherich.com. Thank you for listening.
That was great. So one more time, what was the name of that website?
Taxtherich.com.
Perfect.
One word, tax the rich.
Excellent, excellent. I really enjoyed the examples with Nike and FedEx. That was eye-opening. I know it's broken. I'm not sure I knew it was that broken. Very good. Anybody have any questions for Frank or Morris?
I do.
Go ahead, Darren, and then Roy.
I think Roy raised his hand first, if he wants to go ahead.
All right, Roy, go ahead.
I better be unmuted then. I was just wondering, are there any countries that have a system similar to, a country that has a market and similar to ours, that has a tax system that seems to be fair and workable and, successful?
A lot of countries have more progressive tax systems than we do here in the United States. I mean, I'm not an expert on other countries particularly. The Scandinavian countries have much more progressive tax systems where people who make more money pay far higher rates than people who make less money. But I'm not really familiar with the details.
So we're not going to be like doing something similar to another country, or we might be, but not really realizing it?
Well, I mean, the things that we were particularly complaining about, for instance, the preferential rates for capital gains over ordinary earned income, the 1031 exchange, those are things specific to America in the first place. A lot of places charge people the same rates for all kinds of income. A lot of places have nothing comparable to the 1031 feature. That's a strictly American thing. And a lot of countries have different rules for how they charge multinational companies taxes. So the things that we're particularly concerned about are specific American loopholes that were put into that code specifically by America, for their reasons.
So there's other countries that do have a fair system, or at least fairer than ours. And that's what we are intending to do, is just make the system fair.
That's what we're hoping to do. I mean, we believe that people who make more money should have higher tax rates than people who make less money. Currently, it's exactly the opposite in many cases.
Yeah.
People who make a lot of money from their investments have far lower tax rates than people who actually work for a living. And we think that's not appropriate.
My last question would be, can it be done in a way where anybody can understand it? Because they're always so complicated and convoluted. I just give up.
I think actually we can make change in the tax system to make it a lot easier to understand than it is now. For instance, like explaining the 1031 like kind exchange rules to somebody, that's complicated. Explaining how some income is considered long-term capital gains, but other income is not, that's complicated. Explaining that your wages get deducted from your checks every week, but if you inherit money, there's an entirely different set of rules for that. That's complicated to explain. So I think we could have a far simpler system, even if we have more progressive rates. If we said that these rates apply to all money you get, I think that'd be simpler than the current system, not more complicated.
Thank you, Morris. So next up, we have Darren, then John, Paul, and Sharyar. Darren, you're up.
Yeah, I was just going to ask about the messaging. You had a slide with the job creators thing, and then you showed the bus when they went on their PR tour. It seems, it's not just the wealthy people that are doing messaging. They also seem to get the politicians to do their messaging for them, and the media helps them out quite a bit and just parrots their talking points. I'm wondering if you guys have any information, any ideas about breaking the cultural hegemony that they have going on this, because talking to personal acquaintances or whatever, you have to break through all of that to even begin to educate people on this. And I'm wondering if there were good tactics and strategies to approach things like that.
We thought talking to you was a good strategy.
Thanks.
It should be, but we aren't the politicians. Awesome. Okay.
Comment on that? Just
please.
I do think messaging is really important, and I do think that the lower tax rates in any set of circumstances, people, whatever it is, whether it's in, I live in California, whether it's a Prop 13 kinds of things or whatever it is, the idea of paying taxes is something that everybody can understand and everybody seems to want to avoid if they can. And I think this question of taxing the rich, I think the Republicans have done a pretty good job of saying, well, your taxes are going to go up, whoever you are. When people start talking about tax increases, they associate it with everyone. During the Biden campaign, they found that if you talked about raising taxes for people with incomes above 400,000, you got more than a majority of support for that kind of messaging. I don't know that we've messaged it well enough. I think we have a lot of work to do, but there is a number at which ordinary people say, okay, that's a wealthy person, that person should pay more, as opposed to me. And I think during when the Republicans did the 2017 tax, they kept saying everyone's taxes are going to go down, which was a total lie, because the only people's taxes who went down were the wealthiest top, I think, what is it, Morris, 5%. Everybody else's taxes either stayed the same or pretty much stayed the same. So anyway, messaging is very important, and we haven't done as good a job. Fortunately, we have Patriotic Millionaires. We've got Morris and Erica. They're very good at this, and we are getting the message out.
Absolutely. Thank you, Frank. John Worm, you're up.
So I think we can all agree that the problem is in part political, that we need to find a way to let our representatives act in our own interest and not in the interest of those who may be funding them. So I guess my question is, do you see any value in something like publicly financed campaigns to take some of the money out of politics and maybe allow our representatives to act in our interest?
I think that's been very successful here in New York City. And I think it would be successful if HR 1S1 was passed and was applied to the Congress.
100% behind you there, Frank, or Morris. Yeah. HR 1 would have been awesome. Paul Gibbons, you're up.
Hello. Of course, now my phone has to ring. I'll call you right back. Okay. I'll call back in 10 minutes. It's amazing how these things all synchronize. Anyway, while I'm the last person to say anything good about the tax system, I guess I'm going to be the curmudgeon in the room for a minute and point out a couple things. First of all, you correctly observed that corporations, the income of corporations it comes from consumers, people who choose to buy their products. And if they don't choose to buy their products, corporations have no income. And the fact is that while it is true that if corporations save money on taxes, they don't necessarily pass it along to the consumer. However, on the reverse, if they pay more in taxes, they're almost certainly going to pass it along to the consumer. So the point is, raising taxes on corporations may raise some money, but it's being really raised from the general population, not from the people who are in charge of the corporations. The other question I have is when you pointed out that, or the presentation you shared with us pointed out that people who purchase an asset and then that asset appreciates is taxed at a different rate. But they don't point out to the fact that the money that was used to purchase the asset in the first place was probably fully taxed. So once again, I'm not arguing that the tax system is completely fair and equitable and no changes should be made. Far, nothing could be further from the truth. But I just wanted to point out a couple of areas of
yeah, in terms of the capital gains, let's take that part of the question. If I earn, say, $1 million through a job and I pay taxes on that, So I say I earn $1.5 million and I pay tax and I have $1 million left, and I invest that money. And then I buy some stock that was up to $10 million. When I sell it, I get $10 million, but I only pay tax on $9 million. I don't pay tax again on the $1 million that I'd invested in the first place. So I don't pay tax twice on any of that money. I pay tax on the first $1 million in my example, whenever I earned it to begin with. And I pay tax on the other $9 million after I earn that $9 million. So each dollar that's earned is only taxed once. We just think the tax rate should be the same on earned income and investment income. So I don't think it's a question of double taxation. I think it's a question of single taxation at the same rate for everyone.
That's a good answer.
Yeah. Oh, thank you.
Thank you, Morris. And finally, we have Sharyar. Go ahead.
Yeah, so thank you. Very nice presentation. So first I have one comment and then I have a question here. To Frank, you were talking a little while ago about that people, at a certain level, that people might accept that the taxation, increasing the taxation rate is acceptable to general people. But I have a feeling that the people have bought the Kool-Aid where they believe that the companies, if they're taxed, they will run away to some other country, to Siberia or wherever it may be, okay? And Americans will lose their jobs, okay? People wholesale buy that, most people, that myth. So the question I have for you is not only the tax rates that we have, the last 20 years, last 30 years, the Feds have been keeping the interest rates so low, and that's effectively giving away money to the rich and funding the stock market, okay? And also with the quantitative easing. So, so what do you think of that? That how was the role of the Fed with the QE and with the low tax rates, how that's affecting the disparity in wealth in people?
Interesting question, and I've had a concern about, money is cheaper than it's ever been. I just refinanced my home loan at 2.4%, ridiculous, and so I don't have an answer to that. I really think that the idea, for some reason, the idea of inflation is somehow the biggest evil of mankind. And so the Fed has to do everything possible to avoid inflation. I don't think they have done a good job of balancing that. One of the interesting things that I do think has developed in the last, since the Biden administration, is this international attempt to try to get agreement on basic tax rates for corporations, so that this idea that companies will try to set up business and set up legal entities in the countries that have the lowest tax rates, that there's a movement to try to equalize that. I think that is a real positive from an international standpoint, and kind of goes to the point that Morris was making in the presentation about being able to shift money overseas. But I do not have a good feel for what Fed policy, maybe somebody else has some thoughts on this, Fed policy ought to be. I just think it has been far too loose. I think there's a good 20% of stock market valuation has only to do with the fact that money's available to buy stock and people have nothing else to buy.
But see, on the other hand, there are people, not everyone's invest in the stock market or has the means to do it. That people, many retired people, whatnot, they're putting the funds in a bank account, and effectively, their sum is going down every year, right? So they don't have investments. There's only thing, they have savings accounts or some CDs, which almost pay nothing nowadays. So they're effectively getting robbed, and their money, okay, fine, if I can refinance my house, maybe I gain a little bit with the lower interest rate. But the interest rate low interest rate is effectively transferring money to the rich, okay, and funding the stock market, and so that's the, I think, something to worry about, and the whole media continuously, every day they'll talk about the Dow Jones stock index going up and down so much, which is all we know. It's not the real economy, okay, but on the other hand, we are all conditioned to look at that. I do that every morning. I wake up, I look at, what the stock market is heading that day. Granted, I have very little stock market investment at all. Okay, so, but that's the whole problem, that we are all fooled into believing that we are part of this big economy that most of us has no play. There's an article in the New York Times yesterday, as you have seen, that since beginning of 2020, that the share of the top 1% of the wealth has gone up to 32% in this country, and the bottom 50% own only 2% of the wealth. This is not sustainable.
I think I agree. It's not sustainable. And I think your points are well taken. I'm not prepared to discuss Fed policy really, but I think both you and Frank, I agree with your basic premise that it's creating more and more inequality over time. And, I agree.
So one of the things that, I don't know if you're aware that, what's the name of that book, Morris, Capital in the 21st Century, Piketty, a French professor did this extraordinary detailed study of wealth over centuries, generations, and basically concluded that there is a bias it's just a kind of a natural economic occurrence that R is greater than G. In other words, return on existing capital always historically exceeds the growth rate. And what that translates to is that people who have wealth always do people who are trying to get wealth from the system. And there's an internal bias in all in capitalism toward the distribution of wealth to the most wealthy. And the book is pretty impressive, 640 pages. I actually read it, but it comes down to the fact that you have to really overtly take actions to try to work against these natural trends. And you can think about it as even as simple as those who own the land charge rent. The people who don't own land, who want to buy land, have to earn money off of the products of the land and ultimately never earn as much as the landowner. And historically, if you multiply that forward, you have forces that work toward inequality. And the only period of time in which that has not happened was from the start of the Depression to the mid 70s when Reagan was in office. And it's the case in a lot of countries, but the US is the worst in terms of what's happened to our distribution of wealth. So it's pretty much wiping out the middle class. I don't know if I'm clear on that, but I recommend reading that book or reading the summary. It's kind of depressing because you realize there's a lot of forces moving against going in the wrong direction, and you have to work against those. And taxation is a way of working against those.
Okay, thank you. I'm going to go ahead and wrap up the stream here. If you guys would like to hang out and answer the final two questions, that would be great. Thank you so much for bringing this before us, Frank and Morris. It was awesome. And I'm interested. I signed up on the website. With that, I wish to thank everyone for coming tonight. Remember, if you enjoyed our content, then hit the subscribe button, contribute to our Patreon, become a member of HSGP, or better yet, volunteer to make the magic happen. With that, be well, stay safe, and take care.